Hello, my name is Ken Eades. I'm on the faculty here at the University of Virginia's Darden School of Business. And this is the University of Virginia's Investing Conference 2012. I have with me here Kyle Bass of Heyman Capital. This is Kyle's third year at the conference. And Kyle, over the last 3 years, your investment thesis has been the same. We switched some emphasis maybe from Europe to Japan, but your message and your analysis has been pretty consistent. So I wondered if you could recap that for us, review that for us, the investment thesis, and then what's changed since last year? We've had another year of information for you. Changed your views, changed tactics. What's new?
So no, the data continues to confirm our investment thesis over the last few years and more validate the manner in which we think this is going to continue to play out. Last year there was a lot of conjecture regarding what was going to happen to Greece. Since then we saw an 80-cent write-down and another 10 or 12-cent write-down of the residuals. So if you owned Greek debt, you lost 90 cents on the dollar, and now Greece still has an intractable debt problem with the official sector debts. So thematically, the bottom line is the total credit market debt to GDP globally is 350%. It's $200 trillion worth of debt against global GDP of roughly 62 trillion. So it's of our belief that you're going to continue to see lower global growth, and you're going to see certain countries hit the proverbial endpoint or the wall where they have to restructure their debts. And we've been particularly dogmatic with our view there, and so far it's been close to being, let's say it's been very close with kind of what eventually happens. And investing around that particular idea is very difficult. It's actually, as Dick Mayo said at lunch today, the most difficult time in the world to invest in his lifetime. And I would echo his comments. I would say that investing in the environment that I'm describing to you is the single hardest thing to do as far as investing is concerned over the last few decades. So this is a debt supercycle that's coming to an end. It's coming to an end at various endpoints for different countries. We think that you're going to continue to see yield compression in the developed world. We think the US and Europe could actually see negative nominal rates over the next 12 months, which is something that is, as an academic, very hard to understand, as a participant, really hard to understand. But it seems to me like we're seeing enough rhetoric and research done around the subject that it's actually a real possibility. Maybe it's only a 20% possibility, but the fact that it's even on the whiteboard is something that's, I guess, worthy of paying attention to. So we have invested in all kinds of what I call event-driven credit. We own subprime bonds, some of the top of the front pay, second pay, third pay bonds. We own self-liquidating credit like the Lehman claims and the Glitnir Icelandic Bank claims and things like that. Again, what we're trying to do is keep duration short. We're trying to keep yields as high as we can keep them in the core book. We have a long-short equity book, and then we maintain our convexity in Japan. And a lot has happened in Japan in the last 12 months. In fact, in the last 2 months, we believe they've crossed that proverbial Rubicon. We think that you've seen 20 years of conjecture regarding Japan's eventual demise, and now we see a point where in the last couple of months what you see is a continued deterioration in their balance of trade. It's actually running at about negative 100 billion on the dollar, $100 billion or close to 10 trillion yen. And we think that given this resurgence of Chinese nationalism over the Senkaku crisis, you're going to see that move another 1.5% to 2% of GDP, or another $100 billion. To put that into perspective, what that means is we could see full current account negativity in Japan in October. That's something nobody's ready for. And so when you think about it, you have a secular decline in the population happening. You have a balance of trade that's literally being rewritten and falling off a cliff, and their GDP is now tracking negative 3.5%, negative 4%. So what has to happen in Japan is now their back's against the wall. They have a full crisis, and they absolutely have to change the manner in which they deal with their currency. And so we think over the last couple of months that we've crossed the final kind of Rubicon that turns the whole situation around and weakens the yen from the currency perspective, and yen dollar, yen yuan. And then you're going to start to see, we think, in the next 12 to 18 months, a move in their rates. And basically, Japan's entering its kind of final checkmate phase of the chess game. And so a lot has happened in the last year, but that's something that's really happened recently in the last few months.
but it's not priced in the market.
No.
At least you see a lot of opportunity there because of that.
We do.
And when will the October numbers come out? That would be the event here, perhaps that could spring this or start it.
You know, it might. I don't think it will be the event, but it'll be an event that weakens the currency in the near term. Now, whether that's a long-term move will be yet to be seen, and maybe even it strengthens a bit between this. So it really, that data gets released in mid-December. I'm not focused on one particular data set, and it's naive of me to think that I can call the end of a 70-year debt supercycle with any kind of precision whatsoever. What I'm telling you is when you look at all of the inputs, you look at their balance of trade, you look at their full current account, you look at the fact they've had 10 finance ministers in 6 years. You have the BOJ independence being somewhat usurped or revoked in the last few weeks when there's a press release put on the BOJ's website that was a joint press release from the MOF, the BOJ, and the government. That's analogous to, you know, Bernanke, Geithner, and Hillary Clinton issuing a joint press release saying we're going to end in deflation, right? This is how it begins to happen. You start to revoke the independence of your central bank and let the politicians run monetary policy. Well, this is how it falls apart. So you have Shinzo Abe coming in. The elections in Japan will be around December 16th, and Abe we think is a shoo-in, and he is he's saying they're going to do everything possible to get to 3% inflation. He doesn't even know what he wishes for, because if he gets there, he detonates his debt bomb. So they need to be very careful, but it looks to me like we're entering that next stage of usurping central bank independence, which brings with it some interesting negative consequences.
Next year at this time when we're talking, is it possible that you could be talking about going long on some of these same?
It's possible. Again, I don't want to be naive and say that I think it happens in the next 12 months. All of the ingredients are there to have this vicious cocktail fall apart, but I think that it could probably take a little longer. But to the extent that we see a bond crisis and a yen that has a massive devaluation, yes, we could be talking about going long.
Kyle, thank you again for being at the conference, and we'll look forward to talking to you next year.
Thanks, Ken.